Imagine this: the entire stock market is crashing, panic is in the air, people are losing fortunes, and you're quietly making money. Sounds like a Wall Street myth, right? Wrong. This is the hidden power of short selling, a strategy that flips traditional investing on its head and lets you profit from falling prices. Because short selling isn't for the faint of heart. It's a powerful, controversial, and often misunderstood tool that professionals use to hedge risk, bet against bubbles, and even expose frauds. And Wall Street? They'd rather you stay in the dark. But not today. In this video, you'll discover exactly how short selling works, why it's such a game changer, and how smart investors are using it in 2025. How short selling works, the secret strategy Wall Street doesn't want you to know. Section 1. What is short selling? Short selling, also known as shorting a stock, is the process of borrowing shares of a stock you believe will go down in value, selling them at the current price, and then buying them back later at a lower price to return them, pocketing the difference as profit. It sounds complicated, but it's actually a straightforward bet. I believe this stock will drop, so I'll sell high now and buy it back cheap later. Section 2. How does short selling work? Step by step. Let's break it down into a simple step-by-step process. Step 1. Borrow the shares. You don't own the stock. Your broker lends it to you from their pool or other investors' holdings. Step 2. Sell the shares immediately. You sell the borrowed shares on the open market at the current market price. Step 3. Wait for the price to drop. This is the risky part. If the stock price drops, you're in good shape. If it goes up, you start losing money. Step 4. Buy back at the lower price. When the price falls as you expected, you buy the same number of shares back. Step 5. Return the shares to the broker. You give back the borrowed shares and keep the profit from the price difference, minus fees or interest. Example: you borrow and sell 100 shares of a company at $50 equals $5,000. The price drops to $30. You buy them back at $3,000. Profit: $5,000 to $3,000 equals $2,000 minus fees. Section 3. The power of short selling, why it exists. Short selling isn't just for gamblers or hedge fund managers. It serves critical functions in the market. Price discovery: short sellers help expose overvalued stocks and burst financial bubbles. Market liquidity: by providing sellers in a down market, they increase volume and efficiency. Fraud detection: some short sellers uncover scams or fraudulent companies. Section 4. Real-world example of short selling. Let's revisit the famous GameStop short squeeze of 2021. Hedge funds were heavily shorting GameStop, assuming its price would crash. But retail investors from Reddit's Wall Street Bets turned the tables. They bought shares en masse, pushing the price up, not down, forcing short sellers to buy back at huge losses. One hedge fund, Melvin Capital, lost billions. Lesson? Short selling can bring huge profits or massive losses. Section 5. Pros and cons of short selling. Pros: you can profit in a falling market. Helps balance your portfolio, hedging. Exposes bad or overhyped companies. Losses are theoretically unlimited. You pay fees to borrow shares. Requires advanced risk management. Section 6. Short selling versus buying long. Buying long. You profit when the stock goes up. Your maximum loss is limited to the amount you invest. Your maximum gain is unlimited. There are no extra fees involved. Short selling. You profit when the stock goes down. Your maximum loss is unlimited. Your maximum gain is limited to when the stock price falls to zero. You may face borrowing costs and interest fees. Short selling is essentially betting against the market, while buying long is betting on growth. Section 7. Risks involved in short selling. Short selling carries high risk due to the possibility of unlimited losses. If a stock rises instead of falling, your losses could keep climbing. Short squeezes, when everyone buys the stock, forcing short sellers to cover, driving the price higher. Margin calls, if your position goes against you, brokers may demand more money. This is why only experienced investors or those using tight stop-loss strategies should attempt it. Section 8. How to short a stock with broker platforms. Step-by-step on broker platforms. 1. Open a margin account. Most brokers only allow shorting via margin accounts. 2. Find a stock to short. Use screeners to find overvalued or overhyped stocks. 3. Place a short sale order. In your platform, click Sell Short or Short Sell. 4. Set stop loss and targets. Define exit points to manage risk. 5. Monitor and exit carefully. Price can spike quickly. Watch closely. Popular brokers for short selling. Interactive brokers. TD Ameritrade. Webull. eTrade. Section 9. Tools and indicators for smart short sellers. Short sellers rely on data and indicators to predict price drops. Key tools. Relative Strength Index, RSI signals when a stock is overbought. MACD crossovers indicate momentum shift. High P/E ratios suggest overvaluation. Short interest ratio, high equals many are betting it will fall. Insider selling, a red flag. Pro tip. Combine technical analysis plus fundamental analysis for best results. Section 10. Famous short selling wins and disasters. Big wins. Michael Burry shorted the housing market in 2008 and made hundreds of millions, the big short. Jim Chono shorted Enron before its collapse. Big fails. Melvin Capital and GameStop. Bill Ackman's Herbalife short, lost billions. Moral of the story? Timing and research are everything. Section 11. Myths about short selling, debunked. Myth 1, it's illegal. Fact, it's completely legal and regulated. Myth 2, it crashes the market. Fact, markets fall due to broader economic issues, not just short selling. Myth 3, only hedge funds can do it. Fact, any investor with a margin account can short stocks. Section 12. Ethical questions and regulations. Short selling often faces criticism for manipulating prices or spreading fear, especially during crises. This has led to short selling bans in certain countries during financial crashes. Regulation SHO in the US to prevent naked shorting, selling shares that don't exist. Requirements for transparency in hedge fund positions. Still, it remains a legitimate financial tool when used responsibly. Section 13. When should you consider shorting a stock? Here are signs that short selling may be a good strategy. The stock is in a clear downtrend. Insider selling is high. The company has poor earnings or declining fundamentals. Analyst downgrades are consistent. There's hype with no substance, common in penny stocks or meme stocks. Best times to short. During bear markets. After overblown earnings reports. When bubble stocks are peaking. Section 14. Conclusion, should you use this secret strategy? Short selling is not for everyone, but it is a powerful financial weapon in the right hands. If used with caution, research, and risk management, it allows you to profit when others panic. Hedge your portfolio. Think like a Wall Street insider. But if used carelessly, it can wipe you out. Final tip. Start with paper trading, simulated trades, to practice. Study successful short sellers. Use it as part of a diversified strategy, not your only move. Ready to master short selling? This is just the beginning. If you want to discover more stock market secrets, learn the best short selling setups, avoid costly mistakes. If you found this video informative, kindly give it a like, comment, share and subscribe to our YouTube channel and share this video to your friends. Thanks for watching and see you in the next video.